Hello, everyone. It is Chelsea Fagan here with another episode of the Financial Confessions. And today's episode is going to be very special and very different because this time it is not my questions. These are all your questions that you guys sent in to ask a CFP. And hello, CFP.
Hi.
Introduce yourself. What is your name?
I'm Brittney Castro, and I'm a CFP.
And what does that mean exactly?
Yeah, so a CFP is Certified Financial Planner. So it's a little bit different than just someone who's a financial advisor in the sense that a CFP goes and gets an extra designation. So there's college courses you have to take, a board exam, similar to the CPA exam, and then there's ethical requirements that you have to keep up.
And you work with, so I'm sure you guys probably know this by this point, but this whole show is sponsored by Intuit that makes a lot of the products we love and talk about, like QuickBooks and Mint and stuff. And you work with Intuit.
Yes, so I'm the CFP for Mint and Turbo.
Okay.
So really help with the personal finance side, showcasing the products for consumers, educating people about it. And a lot of people know Mint, which is great. It kind of tracks.
Use it every day.
Budgeting, I do too. Yeah, it's great. Budgeting and accounts, but Turbo's another product that a lot of people don't know about, but it's more of like the overview of personal finance. You can see a little bit more like maybe tips about how to save into savings or pay down debt faster. So it gives you a little extra financial planning, if you will. And also the Turbo product helps people understand where they stand financially and how can they improve their financial situation. So even things like debt to income ratio or how to pay down debt faster or how to open up a savings account and save for different, cash cushion goals or short-term goals, those sorts of things.
So if you already use Mint like I do, you could also use Turbo.
Yeah, so different products, and that's the beauty of it. It's like a lot of people understand Mint, they love it, and this is just something extra to add on top to give you a bigger picture of your financial situation.
Is it free too? Like Mint is?
Yes, definitely free. We love free things.
We love a free app in this house. Okay, so as I mentioned, we threw it out to you guys on Instagram, like what you would ask a CFP if you had one, because obviously in real life, if you have a CFP, you have to pay them. So
yes,
but now you have the opportunity to ask your burning questions for free, and you guys literally sent in hundreds. So we're trying to get to as many of them as we can, and we'll see how many we get through. We picked some of our favorites. Do I put more into my 401k or my Roth 401k? My company matches both.
that's a great question. So this is something we actually work all the time on with our clients. It really comes down to your specific situation. So how much income are you earning? Are you like single filer? Are you joint file? Your tax return? What other tax deductions are you getting for the year? So as we know, the traditional 401k, when you contribute to that, you get to deduct the contribution in the year. If you do the Roth 401k, you don't get to deduct the contribution, but down the road, when you're 59 and a half or older, it comes tax-free. So that's the benefit of doing a Roth. It really, you have to look at your tax situation, like, do you need that extra deduction? Should you do the traditional 401k because you really just want to pay less in taxes today? Or are you okay maybe holding off on that deduction and funding the Roth side of the 401k so you can balance out getting tax-free money in the future? So unfortunately, it's not clear black and white, but a good CPA or CFP can really help you analyze that for the situation and help you determine which one.
Now here guys, I'm going to ask her this question, but I must say, we do get this question all the time, and we try to answer it as many times as we can, and I feel like your answer is going to be very similar. So I encourage you all to write down the answer to this question and put it on a sticky note in your mirror so you all know the answer to this. Debt payoff or savings? Which is the priority?
Well, I'm all nervous if I'm going to answer it correctly, but I would say it's probably a combination of both. And you really have to look at how much debt do you hold? What's the balance? What's the interest rate? What's the cash scenario? How much do you have in your cash reserves? Is that, funding the goal? And kind of determine the priority. And again, if you're paying 15 or a higher percent on your debt balance and only getting 2% in your savings account, well, then you might need to get a little bit more aggressive with the debt, knowing that right when that's done and you free up that cash, you'll just really fund the cash cushion. But you really do need cash in order to pay off debt, because otherwise it's that cycle, and you pay off all the debt, have no cash, then an emergency or opportunity comes, guess what? Use the debt. So it's a little bit of both.
Yeah, the like very specific answer that we generally give is we would advise minimizing debt payoff as much as humanly possible before you have an emergency fund. Because as you said, if you anything happens to you, you could get put into a cycle where you literally can't pay your debt and you now owe money on like a credit card because you had no cash to deal with an emergency. So until you have at least enough cash to like make sure that you can cover any basic expenses if they come up, we would encourage you to like minimize debt payoff. But once you have cash and are in a more comfortable place, like you said, there's probably a number of interest you're paying on the debt, and each debt is going to be different. Some people, for example, have like subsidized student loans that have extremely low interest rates. And if that money, obviously if it's going just into a regular savings account, even a high yield, that's probably going to be pretty low interest wise. But let's say you're investing it, what is the average market return? It's like 6-7% generally. You could weigh that against, certain student loans that are subsidized maybe at 2-3%. And decide that that's like a better thing to like lower what you're putting to the debt payoff and increase what you're investing. But like in any case, it's going to be totally down to the type of debt and the type of savings that you're doing. And we always recommend, like, there are plenty of calculators. TurboTax actually provides one where you can basically just enter in the debt and enter in the savings, and it will tell you which is generally going to be the better place to put it. But again, we've gone through this conversation like 100 times on TFD, so write that one down, guys. What are some financial things I should consider when I'm planning to get pregnant?
Ooh, good question. Well, number one, are you going to take time off? Is it covered? Hopefully you get some maternity benefits through your job. If you don't have that, how will you cover that time in which you decide to take off, whether it's 3 to 6 to a year long? Also, I would say if you're getting pregnant, then you're going to also have additional expenses, hospital stays, review your health insurance benefits, see what they cover, kind of do your best to plan what the baby will bring in terms of extra living expenses every month. I always like to tell clients the baby will bring their own pizza, meaning they'll come with their own money. So don't stress out so much, because I think a lot of parents worry about, oh my God, how am I going to afford the baby? But magically everybody makes it work. It's just kind of part of life. So don't get extra anxious or worry about that, but do planning and figure out, okay, what are those additional expenses? Especially if the mom or dad goes back to work, who's going to take care of the baby? Like, are there going to be nanny costs or, those sorts of things. So I think it's an exciting time, but like anything, do your best, review what you have, what you can plan and prepare for, and then roll with it, because a lot of financial planning is too just course correcting as you go. As you can put a plan, but it's never going to be 100% accurate all the time, because life is not that way.
Now, so if this is something where, like, obviously if you're planning to get pregnant in like the next 6 months, that's a much shorter time window. But if, let's say, it's something that you want in the next few years, is that a good time for like a high yield savings account just for, pre-baby planning?
I definitely would say that. The reality is a lot of people, if you're in a situation where you can put extra money away just for pre-baby planning and a baby, then do it. But also look at all your other goals. I would start there too. Like, look at your budget. Are you even on top of your spending now? Do you have a cash cushion now, just for normal life cash cushion? Do you have... Maybe if you're saving for a home, do you have that funded? Are you on track for retirement? And then, if you analyze all those different aspects of your financial situation now, and you still have the ability to save a cushion for a baby, then yes, of course, go for it. But I think in big cities like LA or New York, it's a little tricky. It's always, how do we stretch the dollars that we have for all these various goals that we're working on? Yeah. And what's the priority?
And this is, I don't actually know if this is on the question list, but kind of related to that, one of the questions that we get constantly, always it's going to be another, it depends. But as a general kind of rule and strategy, What are the kinds of life events for which you would use a high yield savings account? What are the kinds of life events that you would use a CD or something like that, time deposit, whatever? And what are the ones where you would be okay with using the market to maximize your savings?
I think it's a great question. So I tell clients all the time, anything 5 years or less really should not be invested in anything, whether it's real estate or the stock market, because you just don't know. And cyclically, the economy has a 5-year bear bull market run. So like typically every 5 to 7 years, there's like some sort of dip. So if you are saving, for example, for a home down payment and you put that in the stock market because you want higher return, and then 2 years from now, when you're ready to buy the home, you're like, where's my down payment?
Right.
And it's down 10, 20% because the markets are having a down year. You're going to be pissed. You're not going to be happy. But a lot of people go in, like literally, this is a question we get asked all the time. How do I get more return on my money while I'm saving for a home or a property in the next few years? And I'm like, you have to keep it in cash.
Yeah.
Like you have to sacrifice, unless you're just super risky and you're like, want to roll the dice.
Or have a really, really flexible window of when you want to buy.
Exactly, if you're not so attached. And that actually was a conversation I had yesterday with a client. She's like, well, if that was the case, I would actually be willing to wait it out then.
Yeah.
I said, okay, great. So now you're very clear about your decision-making process.
Yeah, I think I've had that conversation a few times with my husband because we definitely would like to buy property. I don't know if we'll be buying our principal residence, but one of the reasons why we're not necessarily interested in buying our principal residence, well, first of all, because we live in Manhattan and no thanks, but more importantly, because if you're not buying your principal residence, that gives you a lot more freedom to the timeline of when you're buying. And we would prefer to use the market to help with that particular savings goal. But then we know that we really have to time it based on when the market is going to be great and take that money out at that point, rather than say like we've found the home of our dreams and it's a bear market and we're screwed basically.
Yeah.
So that's something to consider, because I'm definitely the kind of person who will really fall in love with a property and be like, oh my gosh, I have to have this one. But if your money's tied up that way and it's not the right time to take it out, sorry. So, that's a big thing to consider, because again, that could potentially represent an enormous amount of increased returns on that same, principal investment. But especially when it comes to buying a home, you may not find the homes that you want on the market at the time when your money's ready to take out. And also one thing to consider is that a lot of times the homes are going to be obviously the prices of these homes are going to be very tied to the health of the market. So if it's not a great time for your money that's invested, that's also probably the time when the homes are at their best price to buy. So
yeah, it's kind of
a lot to consider.
Yeah, it is a lot to consider. And that's why I always tell people, just understand your own risk appetite, because what you're going to do or willing to do is different than what I am. And we can do that all day long. And so it's not a matter of, is this the right way or the best investment? It's like, well, what is it that you want and what are you willing to do or not do in order to have it?
Yeah. It's very true. Oh, this is a funny one, because I think it's like we often get questions like this which kind of like misunderstand the terms a little bit. If I'm maxing out my 401k, should I also get an IRA or can I invest instead?
I love it. It's very true.
Yeah.
A lot of people get the lingo wrong. So to be clear, a 401k, if it's traditional, is technically, quote unquote, the same as like a traditional
investing.
IRA, and you are investing. So those are, an IRA and a 401k are just the names of the account. And then you invest the money, whatever one you choose, within the account. So people do get that.
What they mean is like, should I invest in something that's not like a tax advantage retirement account?
Oh, like a brokerage account.
Yes.
Yeah. Okay. So if you're maxing out your 401k, the investments are managed properly for that, you still have extra money that you want to invest for the future, such as like retirement, then yes, you could look at adding a Roth IRA on top of it because it's tax different. If you qualify, there's income limits. Or you can say, I just want a brokerage account, which is just an investment account you open up, invest however you desire. But when you put the money in a brokerage account, you have to be very clear what is the goal for the money? Is this retirement money? Is this money we want for 10 years from now for like property? Like just define it.
If it's retirement money, you're better off putting it in something that's tax advantaged to that
Yeah,
end.
because you get the tax, advantages.
Could you explain to everyone just who may not know the difference between an IRA and a Roth IRA?
Yeah, so I always like to do diagrams, so pretend it's a circle. So an IRA is you add money in for the year, it's tax deductible. It grows tax deferred every year. I just say the IRS is happy you're saving for retirement. They give you a tax break for any growth you might get on the investments. When you take the money out, you have to be 59 and a half to not have a penalty. And at that time, it's fully taxable at whatever ordinary income tax bracket. So no taxes, fully taxable. Roth IRA, completely opposite. So you add money in, no tax deduction. It still grows tax deferred because, again, the IRS is happy you're saving for your own retirement. And when you take the money out, you have to be 59 and a half. And at that point, it's fully tax free. So they complement each other. And that's why a lot of people come and want to know, which one do I do? Do I fund the Roth or traditional, or do I fund the Roth? And again, it depends like on your tax situation, the retirement goal. Do you need the deduction today? A lot of this question maybe like 3 or 4 years ago, everybody in the financial industry was saying Roth IRA, Roth IRA. If you can fund a Roth IRA because there's income limits, then do it because you're going to have tax-free money in the future. Then all these statistics and research came out saying, you know what? Traditional IRA is better because you get the tax break. You know you're getting the tax break. Who knows what the taxes will be in the future? So now everybody's saying the traditional is actually more beneficial. So it really depends.
How do you know if you are getting the best work and value from your CFP?
Ooh, good question. I actually just got this one yesterday at a workshop I taught. Number one, do you like them? I think a lot of people work with financial professionals and really don't like them. And for whatever reason, they think they're stuck. Like, this is the person I've had forever, my parents, or it's a referral, or it's just, they just know my situation. So ask yourself, do you even like the person? Like if they call or email, are you, okay about it? Or do you have like a feeling you're like, ugh, this person? Also, I would say, are they providing you service? Are they responsive if you call them or email them? Are they getting back to you in 1 to 2 days? It really shouldn't take that long, but even that kind of response, I think people just kind of settle. Are they doing outreach? So I think with CFPs or financial professionals, a lot of times they're managing accounts, like they could be wealth managers, and they don't necessarily need to do a lot of outreach anymore because they have your money, they're getting paid on the money. So the service model might not be, Chelsea, calling you quarterly. How are you? Should we do an update to your budget? Should we look at your insurances now that things have changed? Or should we talk about changes in income and expenses and see how that affects your portfolio? Like a lot of times they don't need to do that, but they should, because that's what, you're hiring someone for.
Do all CFPs work on the same structure, like a commission structure on a portfolio, or a fee structure? Or how are they paid? And are they always paid the same?
It's so confusing. I think that's one of the most confusing things about the financial industry is how the different models work. So I always explain it like there's mainly 3 types. So there's, let's just say, a standard wealth manager, or asset manager. They can be a CFP or they can just be a financial advisor. So the CFP label applies to all of these categories. It's just somebody who went through the planning curriculum, really tries to do planning in their model, but they could still be paid and compensated in different categories. So this model, let's just say it's like asset or wealth management model, they charge a percentage. Usually that's how they work. Like,
do they do the percentage of like the overall assets, or do they just do it on whatever the growth is?
The overall assets.
Got it.
So they'll charge, let's just say, 1.5% on your account balance that they manage. So if you have a $500,000 portfolio, they're going to charge you X amount. That's their fee, and they can have whatever service model they want.
That's really going to eat into your returns.
Yeah. So it's fine to pay that if they're giving you service beyond just managing your account, right? Like if they're giving you helping with tax planning, budgeting, just calling you, having a very specific service model, then it's worth it. They need to get paid. Then there's the people way over here who are more or less like commission. So they might be just like the people selling you an insurance product, or maybe just a representative at a financial firm who sells you some mutual funds. It's not very common anymore because of all the robo-advisors. But, you know, back in the day, they used to just charge sales fees on mutual funds. And this can be like upfront 5-6%. And that's how they get paid commissions. Then there's people more in the middle who are more fee only, or, you know, you might see this. There's a lot of promotion around fee only planners. So that's my model, which is basically flat fees for advice, for a service.
Like a retainer almost.
A retainer. And however they decide to operate those services, like some people can offer financial planning, some might do wealth management, but it's all still very specific about how they're charging, either hourly, retainer packages, or even just a flat fee based on the account value.
Got it. It's funny. It's a debate that I get into all the time with my husband, because my husband is someone who's extremely into like the gamification of money. He's very into like being extremely informed himself. Like he loves going in to manage his own accounts every day. Like he loves that. And that's something that is a good use of his time and that he also has an aptitude for. And I'm very much like, I'm not the person who wants to do that. I'm like much more focused on, well, obviously my biggest asset is my business. So I'm very focused on like that, but I'm more the person who would benefit from like, for example, a robo advisor for my investment accounts, because I want it to be very user friendly, very easy, and that kind of thing. And he has always had a hard time understanding, like, why would you give up any of your returns to have someone help you through the process? And I'm like, well, speaking personally, because I'm not going to do it if I'm not being handheld through the process. And particularly if you're just getting started, going to work with someone who can walk you through the process, set you up with a lot of these accounts, give you an idea of like, even help you understand your own goals and how to get there. I'm someone who hugely benefits from that. And so that's something to really consider. It's like, is the alternative that I would, go in and like do everything myself and save a maximal amount of money? Probably not. My alternative would be missing out on a lot of opportunities because I'm either not focused on it or I just won't take the initiative to start.
Exactly. And I think there are more and more planners like me who have a fee-only model who help clients set up on robo-advisors. So we're still leveraging like very cost-efficient strategies for clients. But you're right. Most people are not do-it-yourselfers. Most people need guidance. How do you even open up the account? How should I even think about these goals? What does my budget even need to be? What is the priority of these goals? Am I even on track toward retirement? And that's the value that I provide. Obviously, we all can get the information online. It's not like I'm providing information that you can't find. I'm providing professional guidance, accountability. Sometimes I'm not a therapist, but sometimes even that kind of angle, coaching. That's so true. And I always tell people, actually hiring somebody can help you prevent mistakes too, because we're all emotionally connected to our money. So sometimes you can't see what you can't see, right? And having an outside perspective that's not attached to the scenario emotionally helps. And, especially with our couple clients, we work with a lot of couples. And I think I always act as that, like, great, here's what we're going to do. And we just kind of bring both parties together into that vision and help them streamline.
Totally. But it's just all that to say, I'm someone who talks about money 24/7. And even I don't like to do all of this myself.
I get it. I'm the same way.
And also it's just a question of what is worth your time. For me, it is better to offload some of this stuff because I can do more valuable things with that time personally. And that might be the case for you as well. So know your strengths. But CFPs are not just for millionaires.
No.
A lot of people think they are.
It's a big misconception. A lot of people just think financial people are for millionaires, whether it's a CFP or not. And I wish people just understand everybody needs financial planning. It's not like one day you wake up and you're like, now I've arrived and I get to work with a CFP now. It's actually the people who work with a professional that get to those levels and sustain the levels.
I actually first engaged a CFP when I had a 490 credit score. I was like in collections on like several different consumer debts, and I was like, help.
Help.
And I only did like one session, and it just like gave me such a relief. And to your point, like they're not a therapist, but I cried, and I was like, I feel like I'm gonna, never have any normal adult life because of how bad my situation is. And he was like, it felt so good to hear him be like, well, first of all, let's be clear, I've seen much worse. And although my consumer debt was in collections, the overall number was like quite low compared to like the average student debt. So just like even helping to talk through it can be such a good first step. But
I agree.
Suffice to say, was not a millionaire when I saw a CFP. After repaying debt and maxing out retirement, what should my next big goal be?
I like
I don't
how
know, babe.
people.
What is your goal?
I know. I'm like, I'm going to tell you what your goals are. It reminds me of my friend. He just said the other day, Brittney, what are your goals? And I'm like, relax. I don't know what your goals should be. I think that's a question you need to ask yourself. If you're paid down your debt, you have cash for your cushion, which is typically the reserves you keep in a savings account for opportunities or emergencies, and you're maxing out your retirement and that's fully funded and you're on track. Maybe the next thing would be enjoying your money more. Maybe you take more trips and travel, or maybe you decide you want to build more wealth, so you buy property, or if you have a home, then you buy a second property, or maybe you leverage like a brokerage account that we talked about, which is another way to invest money. And the beauty of that is it's not retirement specific. So if you're not very clear yet what the goal is, but you want to invest money, you can always do it in a brokerage account and get your money invested and growing. And then maybe, 10 years from now, you know what you want to do with it. But I think this is like the fun part. It sounds exciting. Like if you have like the basics covered, now dream a little more and determine what you want to do with your money.
Yeah, I think something that I try to mention quite a lot, I mentioned earlier that we don't think that we would buy our principal residence. And I think a lot of people think that automatically home ownership is the next goal for them, or should be. And I don't discourage home ownership. It's very sensible for a lot of people, but I think that it's important to reframe in your mind as not the inevitable next step for everyone, and that it should be very much based on for example, are you absolutely sure that you are comfortable being in that home for the next 10 years? Because you may find yourself, in a situation or not wanting to live there, or not being able to live there and having to sell into a terrible market or things like that, and also really consider what you're going to need in the home that you own. Are you able to afford today the home that you will want to live in potentially for the next 10 years?
Exactly.
A lot of these questions, I think, people maybe rush through because they just have always been told, especially by their parents, like you need to own a home, you need to own a home. But that's a very, very big decision that I think needs to be taken extremely seriously.
I agree 100%. And a lot of our clients, I'm in Los Angeles, so a lot of them are in big cities, either LA, San Francisco, New York. And lately, what we've been seeing is like people decide to keep their proper rent in LA, buy a property outside a little bit of LA. Like the hot spot right now is like this desert area called Joshua Tree, where the dollars obviously go a lot further, have that kind of rental property under their belt while they still rent in LA. And that works for them. And so that's something, but you're right. Like maybe buying a home isn't the thing for you right now. So don't rush. Like that's why I say really understand what is it you want. Yes. One of our clients, she was like, I need to just travel. Like that's my thing. I'm like, then that's your thing. Like don't risk, getting house poor buying a property if you want to be able to fund these travel, bigger trips every year. And she's like, yeah, that's cool with me, so that works for her. So it's different for everybody.
It's also important to remember, because a lot of people, I think, make the false assumption that if they are buying a home and for whatever reason may need to move or what have you, will just rent out that home. Now, keep in mind, that's usually going to be possible to some extent, but you may be taking a monthly loss on whatever you would be renting it for. And you can easily do the calculation where you live, particularly if you live in a big city where it's very likely that you're renting. So for example, the home that I currently live in, the apartment rather, we pay, so it's $3,200 a month to rent the apartment. If we were to buy that apartment for its market value and we were to put 20% down on the mortgage, including the property taxes, the condo fees, and all of that, for at least the first 5 years, we would be paying just over $5,000 a month for that exact same property. And if during that time we were to leave or what have you and rent it out, we would be renting it out at the market value of $3,200 or whatever it is at that time. So while yes, you could rent it out, and so you're not taking a 100% loss on that property, that's also an enormous differential of what the rental versus ownership value. Now, of course, you are creating longer term value in that home equity. But again, that's something that will take years to really realize itself. So go through and do all of these calculations as a first step is my advice.
I agree. And how you said that was so perfect. It's like running a business. You know, if you buy a rental property, you have to be prepared. Are you going to manage the property? Are you going to hire a property manager? Because technically it's a business. Like I have like my family owns real estate. My parents own real estate. My brother owns like properties up north, and they like did an amazing job making those things cash flow positive using Airbnb. But that is like a thing. Like my brother's fiance is like managing. It's a business she runs to make it really profitable for them. You know, it's not like you can just buy this rental property, get the passive income. You know, you got to put work. So I think anything is work.
Yeah. And if you were to rent that apartment, that $3,200, that's assuming you are doing 100% of the management yourself.
Yeah, not
I think an average cost for a management company in Manhattan is something like $300 a month just to have that person, you know, be there in case of like any kind of issue, the keys, everything to do with the apartment. So that's immediately take that off of whatever the rent is. Like, it's not as good of a deal as you might think it is.
Yeah. But like you said, in the long run, it could be great. But
in the long run, totally.
You just have to know that's a long-term play, not a short-term cash flow, you know, strategy.
It takes a long time for it to become like a rental property that is like really positive.
Exactly.
What is the best way to build credit for beginners?
Ooh, get a credit card. That's the irony here in the US. So if you have no credit, it's probably going to be hard to apply and get a credit card. So you might have to do a secured card, which is basically debit/credit card. You put money behind it. So it's your own money to start, but the activity counts toward your credit score and credit history as if it was a credit card. So it's usually what most people have to start with, unless you just can like get a cosigner right away. So if you're looking to build credit, or maybe you want to even improve your credit, I'm sure you talk about this all the time, but literally the two main factors are paying your bills on time and keeping your debt balance under the 30% utilization. So I would say focus on those two things. All these people have misconceptions around, but what if I get an inquiry on my credit report? How does it affect my score? I'm like, that's so minor compared to the bigger factors, which are just pay your bills on time and keep that balance under 30%. So if you have a $10,000 limit, never carry more than $3,000 balance on the card. And ideally, it's you pay off whatever you're charging. And that's the best strategy, of course. So I think, you know, just go in knowing these factors of the credit score. Don't be afraid of it, but getting that activity going, even if it's just charging a few things. Like I think if you're just starting out, I remember when I was 16, my dad helped me get a credit card, and he told me, you only can charge your gas on this, because I got, you know, it was my license, I could drive. He's like, every month, charge your gas, and I'm going to make sure every month you pay off the gas, because I had a job. And I was like, okay, that was what I was told to do. And I did it. And I'm so grateful he did, because by the time I graduated college, I had 6 years of this amazing credit history of just paying my bill on time. And so by the time I graduated college, I was just, I mean, this is like the challenging part as well, but I had so much credit available to me. Like the limits that were coming to me and offerings were just unbelievable because of that activity I had. But it was a lot of discipline. And, you know, I think that's the beauty of credit. You can really leverage it for a lot of things in life, but you also have to be on top of it and not get under it.
I have a follow-up question that's my own question.
Yeah.
What the heck is the deal? Because I have been rehabbing my credit score. As I mentioned, I used to have like 490 and I've been like really diligent about it. So now I have like 760 something on Equifax and 720 something on TransUnion.
That's so frustrating.
What is the deal with TransUnion?
I wish I could answer this question for you.
Why
It's
are
like
they different?
the greatest mystery of like the financial world. You know, this year though, and I think it started like last year, all these credit card companies started to put the credit score on the dashboard. So now you could see your FICO score. It wasn't like some big mystery of how do you get it and like it takes so long to get it. Like now it's just like available when you log in. So that was huge. But yeah, it's just like interesting. They just have a different like algorithm. And so they shoot out these I know it's the same credit report. It makes no sense.
It's really frustrating for me personally because on one side I'm excellent and on the other side I'm good.
Average. Oh, good.
Good. It's good. I want to be excellent.
Well, we'll just focus on the excellent side.
It was always really funny. My husband has like he can't have the perfect credit score because he's only been in the country for 6 years, but like
where is he from?
France. But it's like as close as you can get. And when we would get mail for the longest time back when my score was still not very good. And he would always be getting like, you know, the Amex Business Platinum, whatever. And I would get like these cards that had like literally clowns and like dogs on them. There was like 26% APR or whatever and had like a $500.
You're like, something's off with our system here.
But I always try to tell people like I've been very, very diligent about my own credit rehab. Like for the first year and a half, I did a rehab credit card at my bank where like you prepay it, but it's treated as a credit card. So I did all that. But the single biggest asset to me was having a partner with a great credit score who could add me to his cards. Yeah. And that's so important because not everyone has those privileges. Not everyone has a parent that can do that or a family member or a partner. And you know, so you don't feel bad if it's taking you longer because you don't have that, you know, advantage.
And don't get discouraged. You know, it's kind of interesting how if you focus on those two main factors, your score can actually dramatically change within a short period of time. I think people have this idea that it's you're doomed for life. And so they kind of don't even try to improve it because it's so daunting. But I've seen it where in 6 months, sometimes it's like night and day, a person's credit score because they paid off some balance. They started getting, you know, auto pay set up on their credit card so they never missed a payment. And those two factors alone can really be a big change for somebody.
And also do remember, so I have a credit card that's like a $300 limit. That was like my first like actual credit card after I like started rehabbing my credit that I only keep open. I don't use it at all, but I only keep open for the history because it's the longest card I have. And I will sometimes forget that it has like a $15 annual fee, and then it's like not paid. And like 3 months ago, it got like a huge ding on my score because I had like a 100% timely, and then it was like a 97% timely, which dropped it by like 28 points. And I immediately called the bank and I was literally crying. I was like, I can't deal with this. Like, you have to help me. You have to help me. And they were like, and I paid it right away. And they called the credit reporting bureaus. And within 3 days, my credit was back to where it was. So you can talk to people. You can do something about it.
Talk to people is key. I think yesterday a woman came to my workshop and she was so upset about, this was in relation to LA city tax that a business owner has to pay. And she was here from a different country and she is learning all the systems of running a business in LA. And she was just so upset. And I said, you know what? I understand your frustration. I really do. I've been there many times with not only mine, clients. This is what I do all day long. But you cannot get on the phone and just yell at people or cuss them out and take out all your anger because you're not going to get anywhere. And so I said, look, I get it. It's an emotional thing. You can cry, you can get angry when you're dealing with the financial stuff, but you have to get somebody on the phone and be calm and centered and tell them what you're trying to do and give them a little bit of a backstory. Chances are they'll help you.
Oh, yeah.
They really will. But you got to play the game smart. Like, you got to have a little bit more of a strategy to get what you want. And I said, look, you got to go like this. We actually said, why don't you go in? Because she was getting frustrated. No one was answering the phone call. I was like, you can always go to the office. Like, I know it's like almost like so old school to go see somebody in real life, but that real life connection goes so far. And I think people just get discouraged. They don't take the action. Like, you were on top of it, you took action. So of course you got it fixed, but it takes those steps. And if you like stop at step one because someone said no, or you just got so emotional and avoided the whole thing, then you're not going to get anywhere. And I think that's kind of like a practice in your financial journey, because whatever it is, dealing with a credit bureau, city tax, IRS, business, attorney, buying a property, closing an estate, there are things you got to do. And,
I would like to clarify for my own reputation that I was crying, but not in an angry way. I was just like, this is the worst day. Please help me. And so they were like, they were nice.
Yeah, well, I think that's a sweet thing. Like, people want to help.
She was this really nice lady with like a Southern accent. She was like, sweetie, it's fine. I was like, thank you, Mom.
Everything's figure outable.
Yes,
really.
Exactly. And also, I think one thing that people often forget is that banks, credit cards, these are businesses. They want your clientele. Like, they want you to be a client. They want to keep you happy. And sometimes you can even go, like I have done before, where I have like gone to a credit card and been like, I want to stay with you guys, but this credit card is offering me like a better, blah, blah, blah. Yeah. And they will match it.
Exactly.
Yeah. These people, and plus, don't forget, a lot of these reps work on commission, so they want to get
help.
you in. I'm 22 with no debt. What a flex! What should I be investing in?
Wow. Well, congrats. You have no debt. That's kind of an accomplishment these days. Well, you can start by asking yourself, what are the goals? I think you always need a cash cushion. We've talked about this many times, that having some reserves just for emergencies. And if you're 22, I would say even have more than the usual 6 months, because there's probably a lot of things that will change in your 20s that you might not like think about, but you want to have the ability to take career risks, or maybe take some time off and travel. And so that was one of my biggest mistakes. I wish in my 20s someone would have told me that.
Right.
Like, just keep a lot of cash, because I was like, I'm going to invest all my money. And I did. And I had all this money invested. But then I didn't have as much cash. So when I wanted to start a business or do all these things, I was like, I need more money for that, but all my money is locked up over here. And I was like, how come no one just told me, like, keep more cash? But if you have that, then you could start investing in a retirement account, whatever it might be. If you're employed, 401k. If not, go get an IRA and start that compounding interest.
How much should spouses intertwine their finances?
As much as it's right for you guys. Like, every couple's different. We have some people who do the full merge, and that works effectively for them. I do think that is the more efficient way to go for many reasons, but some people are completely separate, and that works. And, it's like two different separate accounts, and then they decide how much they want to contribute to the joint expenses or joint goals. I always think, though, even if you're 100% merged, like you have everything go to a merged account first, keep yours, you got to keep your fun money, that money you can just play with and not even have to tell each other about. And obviously retirement accounts.
You're buying Christmas presents.
Yeah, so like have your own accounts, of course, but have I think when couples come together and they see a clear plan as like, here's the income combined, here are the expenses combined, here are the goals, cash cushion, travel, kids, college, retirement. It's a lot easier than to determine how much to put away when everything's coming from this one bucket of money. When it's like, oh, we got to do like a split. It just makes it's just an extra layer of complexity that if you can do the first version, it could be easier in the long run.
I will say though, I'm very much like an everything merged type of gal, but that does mean that I think personally, I believe that puts a much, much higher need for something like a prenup, or basically just some kind of, delineation. Like my husband and I were actually working on a post-nup, but more importantly, he was very instrumental in helping when TFD was just starting. So it was very important that he have his own ownership of the company that's completely separate from mine, even though we're totally married and our finances are merged and all that stuff. And it does make our taxes more complicated and it is a hassle, but it's also something that was like, I want to ensure, particularly because everything's merged and there is no distinction right now, that if anything were to ever happen to us, everyone has exactly what they're entitled to. And there's not as much complication in delineating whose is whose, because if you've been with someone, and listen, I know this is a bummer, but 50% of marriages end in divorce. So be realistic out there. If you do come to a situation where you separate, and not only do you not have any kind of plan for separation of assets, but you've also been doing everything communally for 10 years. And let's say like one person stays home so the other one can work, or like, you have this kind of intermingling where there's a huge lack of clarity as to who has what. Set that up, man. Like make that clear in the beginning when you both are like, obviously madly in love, but also very clear-headed and very lucid about like, what do you deserve,
Yeah, and whether you do that or not, I also think have consistent conversations about money. And I do the money date thing, which is like a weekly date with your money. And I encourage couples to do money dates every week because most couples just don't even talk about it. So even like whatever route you decide with all of this, merge, prenup, postnup or not, have the ability to have conversations regularly before marriage and after marriage, because that is still the number one reason why people get divorced. And I think there's just a lot of fear around money conversations in general. It's vulnerable. You can feel like all your insecurities or doubts are twined in there. But really the couples who just like can talk about money freely are like more happy. They're just happier. And whatever route you decide to take with how you actually do the tactical day-to-day stuff, having those consistent conversations sets everybody up for success, because then it's just more clear. You know the person, you know their fears, you know their strengths, you know everybody's situation, and there's no like secrets or question marks. We work with a lot of divorcees and they don't even know. And that, could be a generational thing. I think our generation is very much like open and conversational and better at communication. But again, like people, it's so strange for me to think that but that's their reality. They were married for X amount of years and just had no clue. Didn't do any of it. Didn't touch it.
That is so scary. And I really think, obviously, like having running a business that is and always has been a partnership. I have two other partners who are not my husband. Has taught me very early on that there is nothing more important than a very clear understanding of not only just like ownership and that kind of thing, but also a shared sense of goals, priorities, values financially. And although it's like some people are like, that's a bleak way to look at marriage, but like essentially a marriage on some level is like you're a little tiny business. You're like you guys Inc. and you're making long-term financial decisions together and you have shared projects, shared goals. Like you might really want to like own a lot of property someday and your partner might be not interested at all in what that will entail. And so really making sure that you are approaching your financial planning with a shared sense of like, we are a team, we're creating something together and we have to both be, really on board with these goals is so important, because without that, it can become, like you said, like you can go through an entire marriage not even aware of what was a priority to the other person.
And oftentimes couples are opposite in the money arena. So one might be a saver, one might be a spender. The personalities of two people are completely different. So even if you have very similar maybe habits, maybe one is more of like the visionary and one's more the realist. So there's so many ways to be that team and partner for each other, because you can balance it out. You can help each other during those difficult times. And there's many transitions in life. And so at any given stage, you can kind of say, who needs to step up more, or, whatever it might be,
Totally.
because that's what a team really is. And it's actually more enjoyable not doing it.
I think it's awesome to talk about. I love to, like, my husband and I were like, we got to start. I was like, I proposed doing like quarterly, like, our like us meetings where it's like, where are our goals? Like, what are we on track for? Like big, like logistical planning. And at first he was like making fun of me, but then he was like, then he did like a quadrant chart of like, what are our KPIs? Anyway.
Ooh, sexy. That's sexy talk. For me.
No, it's true. It's like really
so
fun
romantic.
though. I'm like preparing.
I think it is.
I'm like going to make a deck for our next one about like, where are we going this year?
I love you guys. Can I just be like on the wall next time?
Yes. No. I mean, like,
I'll
true.
just be in the room next session you guys have.
Yes, exactly. Well, yeah, I work obviously in the financial area, and he used to be a management consultant. So it's like,
you guys are
bring
very
that together,
strategists.
and it's like, what are we going to accomplish? Okay, last one. He's not gonna listen to this probably because I'm gonna like dissuade him from doing it, but he'd be
don't
so
listen.
humiliated. How often should you really check your credit score?
Ooh. If there's not a lot happening, you really don't need to do it more than every quarter, even every year, because the credit score, again, is just the number coming from your credit report and credit history. So if you're not applying for a loan, or there's no major changes, you have your consistent bill pay on, and things are kind of status quo, you don't need to check it often. If you want to be really on top of it, and maybe you are applying for a loan or working on improving your credit score, then yeah, maybe monthly is a better game plan. I think anything more than that might be a little neurotic and might cause more anxiety than anything, unless it's like very specific reason why you need to. Like if you're applying for a loan and you're like, I need to get this score up to a certain amount and then I'm going to be ready. But really the score is not going to even change that much every month because of the reporting.
What about your net worth?
Oh, net worth. I like monthly. I'm like a monthly girl on a lot of this stuff. Like all my bookkeeping with my own budgets, I do look at my net worth monthly. I also do weekly money dates, so I every week check in overall. But I think more than that, like I said, unless there's something major happening, it just adds a lot of extra
I agree. I think about it a lot because I tend to be like an obsessive looker because I've been through a lot financially. So I just love being like, oh, is everything okay? Actually, one last question that is my own. Recently we had on, and this was Caitlin Doty, The Good Death, whom I adore. We did an episode with her recently. We'll link that. Where when she was answering her biggest money mistake, she had shared that this was actually in like December of 2018. She'd been watching like CNBC or something, saw that, the market was down 25%, and she pulled out all of her money, lost $8,000 in a day. And my take on that is, if I ever see a dip like that, I distinctly don't look at my accounts for like at least, a week or so, because I'm like, I'm not going to just torment myself with that horrible number. What would your approach be on a day like that?
Yours.
Oh, okay, good.
Yeah, very similar. I think especially if it's long-term money and you knew going in, there's a range that you have to be willing to stomach to get this average return. Everybody wants that average return of 8 to 10% on their retirement money. But when it goes down to that negative 25, which is part of the game, they'll freak out and do the mistakes. But anything that's positive, you're like, great, everything's wonderful. Right. I'm like happy. If you want this average return, here's the range. So on days like that, you can't freak out. You can't pull out because that's the game you decided to play in the beginning.
Marathon, not a sprint, baby.
Yeah. And I think in general, less impulse decision making, the better. Usually most things in life, you can take a day or two and think about it, meditate, do what you need to do to come to the more calm centered decision versus, oh my God, I have an emotion. I'm going to react from this emotion. I mean, I just know that in my life, I've those are all the mistakes I've made when it's more of the impulse decision making.
Well, thank you so much for taking this time.
Yeah.
As a reminder, she is a personal finance expert who works with Intuit to help create Mint and Turbo, which are two awesome free apps that can be used in tandem to like totally manage your financial life. And fun fact, if you're like me and already use Mint every day, they just added weekly credit score pushes to keep you up to date on exactly how your credit is doing. She's also a CFP. And where can people learn more about you?
Yeah, you can come over to financiallywiseinc.com. All my stuff's on there. Follow me on all the social media. I'd love to connect.
Awesome. So do not forget to check out Mint, Turbo, and all of the other awesome products that Intuit offers at the link in our description and our show notes. And keep getting financially healthier. Have a great week, guys. Bye.